And so energy is obviously one of the key things affecting all markets, not just obviously energy markets, but also impacting everything else because energy touches pretty much everything in our lives, financially and otherwise. And so, my view of the energy market over the past year or more has been that supply side issues are starting to come to the forefront, and that this is obviously going to cause significant inflationary pressures, both for the energy sector directly and then also for the broader economy. And so, generally speaking, commodities go through these very large capex cycles. There's periods of time where commodities are structurally oversupplied, prices are low, nobody wants to invest. There even in more recent terms, there could be other reasons why they don't invest, like an ESG overlay onto those financial reasons. But for a variety of reasons, nobody wants to invest in the space. But then over time of that not occurring, eventually you work down the existing supply, right? So wells start to run dry, demand starts to slowly creep up over time until you go back above equilibrium. And so then you start to get rising prices, and then more and more supply comes online, and some of those take many years for the bigger projects to bring online until eventually they overbuild, cause a period of oversupply and low prices again. They start the whole cycle again, and this is a pretty long-term cycle. And so my contention for a while now has been that we are entering a decade of much tighter commodity supply in general and energy supply specifically, and we're starting to see that manifest this year. And my view is that it won't be a straight line. So I'm not trying to say, chart oil on a week by week basis and make those specific calls. It's more about the fact that, in the years ahead, through ups and downs, that we're looking at structurally higher energy prices most likely.
Lyn, another topic that you've written quite a bit about is inflation. Now, to what extent is this oil price event that we're having about inflation in the economy, and to what extent is it about the Russian war? President Biden has, of course, described this as the Vladimir Putin price hike. Is that what's going on here, or is there more to it?
Great question. And I actually look back to three times I was on your show before. We centered the conversations around inflation. So my first appearance in mid 2020 was called The Road to Inflation. And then the next two appearances after that were really about how inflation's being driven in large part by the fiscal side. And so it's not just bank reserve creation this time around, unlike the 2008 crisis. This is actually, significant fiscal stimulus that actually increased the money supply and broad circulation among most economic participants, and that people can take that extra money and go out and buy things with it. And so now, even though we're getting a pullback in terms of that money supply growth and that fiscal stimulus, those effects are still working their way through the system. And so my view is that it's the combination of the monetary inflation that we've seen, as well as that commodity cycle. And so we can see over time, there's very significant persistent growth in the broad money supply, and that is of course the unit of account that we're looking at when we're measuring oil prices. But then when you combine that with the fact that you have these big commodity cycles, bull markets in the 1970s when you had shortages, bull markets in the 2000s when you had shortages, bull markets recently when we've had shortages, these represent these huge stepwise increases in the price of energy, and then you go through a long consolidation phase. So my view is that it's both the unit of account going down significantly, basically significant, monetary debasement, broad money supply increases, as well as where we are in the commodity cycle. And when we look at the order of events, we started to get rising energy prices before the war. That obviously added a lot of extra volatility and uncertainty onto energy prices, but it wasn't as though this was not happening before that war occurred. And then specifically when we look at European natural gas prices, which are arguably the craziest energy charts out there at the moment, those also broke out in late 2021, which was again before any sort of a conflict began. And so I think what we're looking at structurally is that the increase in the broad money supply is part of what contributed to the breakout of energy prices, because we basically increased people's demand to buy more energy intensive things. But then, as that supply constraint exists, that will be a persistent inflationary pressure going forward. And so, for example, if you look at slide 5, that shows the 5-year rolling cumulative changes in both oil and CPI over time. And that chart goes back well over a century. And what you generally see is a very strong correlation between energy prices and broader inflation, with the notable exception being the 2000s. That was the biggest decoupling we've had. We had basically rather high energy prices without the level of inflation we'd expect from those high energy prices, and that was because our other disinflationary factors were so strong. That was kind of at the peak rate of globalization. So we were aggressively pushing jobs out to China. We were tapping into this large untapped pool of labor throughout the developing world. And so we had these big offsets that we could offset inflation with. It didn't necessarily translate into sharply rising domestic wages. It didn't translate into sharply rising manufacturing costs because we had all these offsets, as well as just rapid technological growth. But I think that we're going to be unable to repeat that this time around. That basically, we're no longer have, China's already quite developed. They already have, potentially a working population peak in place. They're already rather, developed in that sense. And we don't have a lot of other levers to basically offset some of this inflation with. And so I think going forward, we're going to see a tighter relationship between money supply growth and CPI because we don't really have those offsets to work through.